How to retire early with $1 million in index funds. Introduction: The dream of early retirement. Welcome, everyone, to a journey that many dream of, and a journey that is, indeed, within your reach, the path to early retirement with a solid foundation built upon the power of index funds. I'm your guide on this exploration, someone who has spent years observing the ebb and flow of financial markets and helping individuals like yourselves chart a course toward lasting financial freedom. Whether you're just starting your career, or you're well into your working years, the principles we'll discuss today are timeless and universally applicable. Now, the idea of retiring early, perhaps even decades before the traditional age, often feels like a distant fantasy, something reserved for the exceptionally lucky or the already wealthy. But I'm here to tell you that with a clear understanding of fundamental investment principles, a disciplined approach, and a strategic focus on the remarkable efficiency of index funds, this dream can become a tangible reality, even with a target as specific as reaching a $1 million nest egg. In the next 30 minutes or so, we will delve into the how behind this ambitious yet achievable goal. We won't be discussing get-rich-quick schemes or speculative ventures. Instead, our focus will be on building a robust, long-term strategy that leverages the inherent advantages of index fund investing. We'll break down complex concepts into easy-to-understand segments, ensuring that no matter your current level of financial knowledge, you'll walk away with actionable insights and a renewed sense of possibility. So, settle in, perhaps close your eyes and imagine for a moment what early retirement would mean to you. What passions would you pursue? What experiences would you embrace? Hold that vision in your mind as we begin to lay the groundwork for making it a reality. Understanding the power of index funds. To begin our journey, it's crucial to understand the cornerstone of our strategy, index funds. Now, the world of investing can often seem filled with complicated jargon and the allure of picking the next hot stock. But beneath all the noise lies a remarkably simple and effective approach centered around these investment vehicles. Think of an index fund as a basket that holds a little bit of many different companies, all designed to mirror the performance of a specific market index, such as the S&P 500, which represents the 500 largest publicly traded companies in the United States. When you invest in an S&P 500 index fund, you're essentially investing in the broad success of the American economy. Similarly, there are index funds that track other market segments, like small-cap stocks, international stocks, or even the bond market. The beauty of this approach lies in its simplicity and its inherent diversification. Instead of trying to identify the few winning stocks among thousands, which even seasoned professionals find incredibly challenging, you're investing in the overall growth of a market. This diversification helps to reduce risk. If one company in the index falters, the impact on your overall investment is minimal because you have holdings in hundreds or even thousands of others. Furthermore, index funds are typically known for their low expense ratios. These are the annual fees charged to manage the fund. Because index funds passively track a market index rather than employing a team of analysts to actively pick stocks, their management costs are significantly lower. Over the long term, these lower fees can have a substantial positive impact on your investment returns, allowing more of your money to work for you. So, as we move forward, remember this fundamental principle: index funds offer a diversified, low-cost, and historically proven way to participate in the growth of the financial markets. They are the reliable vehicle that will carry us toward our goal of early retirement. Setting your target, the $1 million goal and beyond. Now that we understand the vehicle, let's talk more specifically about the destination, reaching that $1 million milestone. For many, $1 million represents a significant level of financial security, a number that feels substantial enough to potentially support an earlier than traditional retirement. It's important to recognize that $1 million is a benchmark, and the actual amount you need for early retirement will depend on your individual circumstances, including your desired lifestyle, your anticipated expenses, and where you plan to live. For some, $1 million might be a comfortable starting point. For others, it might be a stepping stone to a larger goal. However, $1 million serves as a powerful and motivating target. It's a concrete number that allows us to create a tangible plan. And the principles we discuss in reaching this first million will serve you well in continuing to grow your wealth beyond that point, if that's your aspiration. Think of this $1 million not just as a lump sum, but as a foundation that can potentially generate income for you through withdrawals and continued growth. We'll touch upon safe withdrawal rates later in our discussion, but for now, let's focus on the accumulation phase. Reaching this milestone is a testament to consistent savings, smart investment choices, and the power of time working in your favor. So, whether $1 million is your ultimate target for early retirement or a significant step along your path, understanding how to reach it with index funds provides a clear and effective roadmap to take control of your financial future. The power of time, starting early, regardless of age. This leads us to one of the most crucial factors in the journey to early retirement and wealth accumulation, time. It is often said that the most powerful force in the universe is compound interest, and time is its greatest ally. Whether you are in your 20s, 30s, 40s, or even 50s, the principle remains the same. The earlier you begin investing, the more time your money has to grow and compound upon itself. Compound interest is essentially earning interest not only on your initial investment but also on the accumulated interest from previous periods. It's like a snowball rolling downhill, gathering more and more snow as it goes. For younger listeners, even small amounts invested consistently early in your career can grow into substantial sums over the decades, thanks to the long runway of compounding returns. Don't underestimate the power of starting with what you can afford now. Even if it seems insignificant, the years ahead will work wonders. For those who may be starting later in their careers, please don't be discouraged. While you may have less time on your side, you likely have greater earning potential and the ability to contribute larger amounts. The key is to start now and to be diligent and strategic in your approach. The beauty of investing in index funds is that it's a long-term game. It's not about timing the market or chasing the latest trends. It's about consistent contributions over time, allowing the natural growth of the market to work in your favor. So, regardless of your current age, the most opportune time to begin building your early retirement fund with index funds is today. Calculating your savings rate and timeline. Now, let's get a bit more practical and talk about how to estimate the savings rate and timeline required to reach that $1 million goal. It's important to understand that this will vary based on several factors, including your current savings, your desired retirement age, and the expected rate of return on your investments. Historically, the stock market, as represented by broad market index funds like the S&P 500, has delivered average annual returns of around 7 to 10% before inflation over long periods. For our calculations, we'll use a more conservative estimate of, say, 7% to account for potential market fluctuations and inflation. Let's consider a hypothetical example. If you are 30 years old and wish to retire by age 55, an early retirement of 25 years, you have a 25-year investment horizon. To reach $1 million with an average annual return of 7%, you would need to save and invest a certain amount consistently each month. There are many online compound interest calculators that can help you run these scenarios based on your specific circumstances. The key takeaway here is that the more you can save and invest consistently, the sooner you are likely to reach your goal. Analyze your current income and expenses to identify areas where you can increase your savings rate. Even small adjustments can make a significant difference over the long term. It's also important to regularly review your progress and adjust your savings rate if needed. Life circumstances change, and your financial goals may evolve. Being proactive and staying informed is crucial to staying on track. Remember, this is a marathon, not a sprint. Consistency and discipline in your savings and investment strategy are far more important than trying to make dramatic gains overnight. Building your index fund portfolio, simplicity and diversification. As we've discussed, index funds are the core of our early retirement strategy. Now, let's talk about how to build a well-diversified index fund portfolio. The goal here is to keep it simple and effective. A common and often recommended approach for long-term investors is a three-fund portfolio. This typically consists of a U.S. total stock market index fund. This provides broad exposure to the entire U.S. stock market, from large corporations to smaller companies. An international total stock market index fund. This diversifies your stock holdings beyond the U.S. and provides exposure to the growth potential of global economies. A U.S. total bond market index fund. Bonds generally tend to be less volatile than stocks and can help to reduce overall portfolio risk, especially as you get closer to retirement. The specific allocation or the percentage you hold in each of these funds will depend on your individual risk tolerance and your time horizon. Generally, younger investors with a longer time horizon can afford to take on more risk and may allocate a larger percentage to stocks. As you get closer to your retirement goal, you might consider gradually increasing your allocation to bonds to preserve capital. You can easily invest in these types of index funds through brokerage accounts offered by many reputable financial institutions. These brokerages allow you to buy and sell shares of index funds, often with very low or even no commission fees. The beauty of this simple, diversified approach is that it captures the returns of the entire market segments without the need to constantly research and select individual stocks. It's a low-maintenance and highly effective way to build wealth over time. Staying the course, managing market volatility and emotions. Investing in the stock market inevitably involves periods of volatility. There will be times when the market goes up, and there will be times when it goes down. This is a normal part of the economic cycle. One of the biggest challenges for long-term investors is managing their emotions during these periods of uncertainty. It's crucial to remember that when you are investing in broad market index funds for the long term, short-term market fluctuations are just that, short-term. Trying to time the market by buying low and selling high is notoriously difficult and often leads to missing out on potential gains. The best approach is to stay the course, even when the market experiences downturns. In fact, Periods of market decline can actually present opportunities to buy more shares of your index funds at lower prices. Think of it as putting your money to work when things are on sale. It's also important to avoid making emotional decisions based on fear or greed. Don't panic and sell your investments when the market drops, and don't get overly exuberant and chase speculative investments when the market is booming. Stick to your long-term plan and continue to invest consistently. Regularly reviewing your portfolio and rebalancing it if necessary, selling some assets that have grown significantly and buying more of those that have lagged behind, can also help you stay disciplined and maintain your desired asset allocation. Remember, building wealth for early retirement with index funds is a marathon, and staying mentally and emotionally prepared for the inevitable ups and downs of the market is essential for long-term success. Withdrawal strategies for early retirement. As you approach your early retirement goal and that $1 million milestone, it's important to start thinking about how you will eventually access and utilize those funds. A key concept here is the safe withdrawal rate. The commonly cited guideline is the 4% rule. This suggests that you can withdraw approximately 4% of your total investment portfolio in the first year of retirement and then adjust that amount for inflation in subsequent years, with a high probability of your money lasting for several decades. Using the $1 million target as an example, a 4% withdrawal rate would provide you with $40,000 per year in income. Whether this is sufficient for your desired early retirement lifestyle will depend on your individual expenses. It's important to note that the 4% rule is a guideline based on historical data and various market scenarios. Some financial experts advocate for a slightly lower withdrawal rate, such as 3% or 3.5%, to provide an even greater margin of safety, especially in an era of potentially lower future investment returns. As you transition into early retirement, you'll also need to consider the tax implications of your withdrawals, depending on the types of accounts you've been investing in, e.g., taxable brokerage accounts, traditional IRAs, Roth IRAs. Having a well-thought-out tax strategy is crucial to maximizing your after-tax retirement income. Furthermore, you may want to explore other potential sources of income in early retirement, such as part-time work, pursuing a passion project that generates revenue, or other investments. The goal is to create a sustainable income stream that supports your desired lifestyle without depleting your nest egg too quickly. Planning your withdrawal strategy is just as important as the accumulation phase. It's about ensuring that the wealth you've diligently built provides you with the financial freedom and security you've worked so hard to achieve. Beyond the numbers, crafting your ideal early retirement life. Reaching $1 million in index funds and achieving early retirement is not just about the financial aspect. It's also about envisioning and creating the life you want to live. What will you do with your newfound time and freedom? This is the time to think about your passions, your hobbies, the experiences you've always wanted to pursue, and the relationships you want to nurture. Early retirement provides you with the opportunity to design your days on your own terms, without the constraints of a traditional work schedule. Perhaps you've always dreamed of traveling the world, volunteering for a cause you believe in, spending more time with family and friends, learning a new skill, or starting a small, passion-driven business. Early retirement can provide you with the time and financial flexibility to make these aspirations a reality. It's wise to spend some time planning this aspect of your early retirement as well. Consider what activities will bring you joy and fulfillment. How will you structure your days to maintain a sense of purpose and engagement? The financial planning we've discussed provides the foundation, but it's the vision for your life beyond traditional work that truly makes early retirement a rewarding and fulfilling experience. Conclusion: taking control of your financial future. And so, we reach the end of our exploration into the path of early retirement with $1 million in index funds. I hope this journey has provided you with clarity, inspiration, and a renewed sense of confidence in your ability to take control of your financial future. Remember, the principles we've discussed are not secrets reserved for a select few. They are fundamental truths about investing and wealth building that are accessible to everyone. The power of index funds, the magic of compounding, the importance of starting early and staying disciplined, these are the tools that can help you achieve your financial goals, including the ambitious yet attainable dream of early retirement. The journey may require effort, consistency, and a long-term perspective. There will be ups and downs along the way. But by understanding the fundamentals, creating a solid plan, and staying focused on your objectives, you can significantly increase your chances of reaching that $1 million milestone and enjoying the freedom and fulfillment that early retirement can offer. So, take the first step today. Analyze your financial situation, set your goals, and begin building your index fund portfolio. The path to early retirement is within your reach, and the time to begin is now. Thank you for joining me on this important exploration. I wish you all the very best on your journey to financial independence and a fulfilling early retirement. How to retire